Hey guys, this is Toby Mathis, and I'm joined by none other than Troy Butler, and we're going to be talking about bookkeeping today. Specifically, we're going to dive into the most common mistakes that people make when they're setting up a company or even running their investments. And so first off, hey Troy.
Hey Toby, how are you?
I'm doing absolutely fantastic, and hopefully everybody out there is too, but let's dive right on in because we want to get right into the content. So what is bookkeeping at its most basic?
It's record keeping, just keeping track of all your income and expenses that a company may have.
And what does the IRS require? Like, what does that mean to somebody sitting out there? Like, what does that mean to somebody? What records do you have to keep?
So the IRS is not very specific, as they usually aren't. And they really don't have a whole lot of guidelines of what is bookkeeping. So
I remember they had a webinar for professionals, and they tried to pin them down. But we know it's like income. We know it's like expenses. It's just what's required to keep all those things, right?
Correct. Yeah, and there's thousands of different softwares that help you do it. It can be as basic as Excel. It can be as complex as QuickBooks Enterprise. It costs thousands of dollars a license. But for most of our clients, there's a nice middle ground where we can find something that works for everybody.
All right. What's the most popular or common software programs?
QuickBooks, by far.
QuickBooks is the gold standard.
Yeah, and for a reason. They're very user-friendly. Most people can figure out how to use QuickBooks, and if there's ever anything you can't figure out, there are thousands and thousands and thousands of tutorials and classes you can take to teach you the basics.
Okay, but at its most basic, because before we had QuickBooks, you still had to keep books, right?
Yes.
Now, and here's the thing I want to stress. I don't care what kind of business you're in, you're required to keep books. I don't care if you're a sole proprietor, partnership, S Corp, C Corp, LLP, LLLP, it does not matter. The IRS has the same requirement on all of those.
Correct.
Right? So, so there's a misnomer out there that, hey, I set up a company and therefore now I have to do bookkeeping. You always have to do bookkeeping. It's just monumentally more difficult if you don't have a separate structure. And one of the things that we see, for example, is the audit rates of sole proprietors are significantly higher than their corporate brethren, and the loss rate is about 95% when they do get audited because, bad books. So let's break down bookkeeping into its little pieces. So I've heard of profit and loss. Most people have heard of balance sheets and cash flow statements and all this. What are the things that all companies really must have?
So first and foremost, the two you mentioned, profit and loss statement, a balance sheet, general ledger. If you have those three, you're pretty well covered.
And do I have to have do I have to go into 3 different programs? Do I have to put it on 3 different Excels, or could I have one Excel sheet and a good bookkeeper is able to piece it out and put it into its form?
Yeah, absolutely. You could definitely have one program or one Excel sheet to kind of keep track of it all, and then, like you said, a good accountant can parse it out from there.
All right, so which of those 3, so you said profit and loss, balance sheet, and general ledger, what's the client going to be interacting with the most?
Probably the profit and loss.
Okay, so explain to folks what a profit and loss is.
It's kind of what the name implies. It reports your profits and your losses. It's also known as an income statement. It's your gross profit minus all of your expenses gets you your net profit.
All right, so if I pay you $1,000 for services, that's going to show up as
income.
Yeah. And then if while you're doing that, you have to pay for QuickBooks, and you have to pay for a license, and you have to pay for lunch, what do those show up as?
Expenses.
All right, and so there's a big category of expenses. Yep. Perfect. And then the net is
what you're taxed on, is the difference between the two.
All right. What's a balance sheet then?
Balance sheet kind of shows all of your company's assets, its liability, and your equity.
Okay, so those are big words, so let's go through those too. So back to your business, you buy a computer. That's going to be an expense, but also now you have a computer. Is that an asset?
Possibly.
Possibly? Okay.
But yeah, if you buy a piece of equipment, that would probably be an asset.
All right, how about we'll go to our real estate investors out there. Our real estate investor buys a property. You can't expense the property, right? So it's gonna go on a balance sheet.
On a balance sheet.
But I know that the balance sheet interacts a little bit with that profit and loss.
It sure
too.
does. Yeah.
Yeah. How does it do it?
Depreciation.
Aha. So then once we have an asset, we get to take a portion of it and move it over to the expenses and offset our income. That's how those two interact. So I want to still break this down. Let's say that again, it's your business, it's Troy's bookkeeping, and you have a credit card. Where does that show up?
It's going to show up as a liability on the balance sheet.
All right, and then the specific items that you buy.
Those are going to be expenses on the profit and loss.
Yep. See how these things start interacting? Like everybody always thinks there's a balance sheet over here, there's a profit and loss over here, and that they have nothing to do with each other. No, all of these things interact. And so you have your assets. Let's say that you have a house and it's worth $300,000. And you have a mortgage on that house. That's going to show up as a liability, right?
Correct.
So the house is sitting there as an asset. Then you have a liability of a mortgage, and the difference between those, you said, is equity?
Correct.
Which is basically like a fancy way of saying if it was an individual, your net worth, but this is your company net worth.
Yeah, exactly. Right? And like the Webster's definition of that is if you sold all of your assets and paid off all your liabilities, this is what your equity is, what would be left.
Yeah, and a lot of people skip that part when
Correct.
they're valuing
Yeah.
their companies. They're like, oh, my company's worth $1 billion. So they're trying to create assets. Like when you see a tech company, their assets is their intellectual property, and they're just plucking stuff out of the air sometimes. Mm-hmm. Whereas if I buy something, it's really easy to say what it's worth. Although, let's be real, if I buy a house, it's not really what it's worth. After 10 years, that
Right.
house could be worth a lot more. But on the balance sheet, that asset's going to look...
Yeah, it's going to be what you paid for it.
And then does the depreciation lower it?
Yes. Yep.
Yep, so you could end up with a balance sheet that looks pretty horrendous, right? But you actually have value. Hence, you have guys like Warren Buffett who are value investors that are experts at going on to balance sheets and figuring out what assets actually have value. But that's a topic for a different day. All right, so we have a profit and loss, we have a balance sheet, and then the third one, what is this general ledger?
Yeah, general ledger is just a listing of all the transactions that happens within your company and all the accounts. So if you ever see like an old movie where like the mob bosses have a book of all their transactions,
That's the
general ledger. Yeah.
And then they're taking that and making it into a P&L and a balance sheet.
Correct. Right.
All right. So from a client's perspective, if they don't want to learn bookkeeping, they could just keep a general ledger and hand it off to you?
Yep, that would work.
And then a good bookkeeper is going to be able to take those items and place it on the right sheet.
Yep.
And it's going to be able to take the right, like, again, the way that you depreciate things, if you didn't know, is the IRS says, here's useful life. You have, let's say it's a computer, it's 5 years, and then you have things like sections that allow you to accelerate that into 1 year, like 168K and 179. There's like some ways to accelerate that. But at the end of the day, there's a useful life on most items, and that's what the bookkeepers are using. Generally, that's what you guys do?
Yeah, absolutely.
And then you're able to say to somebody, hey, get with your accountant to decide whether you want to go faster or slower, depending on what that P&L is saying. Yep, that's exactly it. All right, so we've covered the basics. Profit and loss, balance sheet, general ledger. The profit and loss has items of income and expenses. The balance sheet is assets and liabilities. Correct. And the general ledger is every transaction. So from a client level, that general ledger is where if you could just document every financial decision or everything you do, and I shouldn't say decision, it's your transactions, and you put it on general ledger, and you hand it to a guy like Troy, they're going to be able to put together your books.
Yep.
Right?
Absolutely.
All right. What are the most common mistakes now? Can we dive into that?
Sure, absolutely.
Unless there's anything else you want to hit on those.
I don't think so.
All right. Let's go into the common mistakes then that we see. What do you see as some of the top mistakes?
Yeah, and this is specific to our real estate investors when they set up a management company, or really doesn't necessarily have to be real estate, it could be anything that has a management C Corp. They list out all the expenses for whatever they're managing on the C Corp rather than where it should be. So like they'll take the income and expenses of the rental property on the C Corp and put it all on the books there. So really where you need to report the income and expenses is where the property is owned. So if you have a holding company that owns a piece of real estate and they're renting it out long term, that real estate income and expenses need to be reported with the holding company, not the C Corp.
Okay, I see what you're saying. So in the structure that Troy's referring to is typically you'll have somebody that has multiple real estate properties. They're generally held in LLCs, and that LLC is generally held by a holding LLC. From a bookkeeping standpoint, you probably keep that on one set of books, right? You have the holding, and then you have each property LLC as a class.
Exactly.
Right, and you have that broken down. So without getting into too specific, it means the way we structure is so that it's simpler on your bookkeeper. Now, a client may have a property management corporation that's receiving the rents and is paying the net rents after it's covered all the repairs, covers expenses on behalf of that property. Sometimes the corporation is writing it out on behalf of the holding company and the real estate company. And the question is, which return does that really go on? And if the property owner is the holding company, if I'm hearing you correctly, a lot of those expenses should be on the holding,
Correct.
Even though it may have been written by the corporation on its behalf.
Exactly.
Yep.
And so the way you do that is you make use of what accounts called due to and due from. So basically, one company owes another company money. So it's an asset on the company that's due the money, and it's a liability on the company that owes the money.
And I'm just going to stop it right here because some people's heads exploded.
Okay.
And we're just going to say general ledger. Remember, profit and loss, balance sheet, general ledger. If you can keep a general ledger of what an expense was paid, hey, I paid it out of this company, and this is what it was for, then a bookkeeper can make sure it ends up on the right on the right P&L and balance sheet.
Correct. Yep.
Because technically, if you have remember that books and records are necessary of any investor. So if it's you have to keep books and records. If it's an LLC, it has to keep books and records, right? It needs to be able to figure out what its income and expenses are, what its assets and liabilities are. So you could have a holding company that has 20 LLCs underneath it. It's one set of books for that holding company because that's the ultimate taxpayer. Although you are tracking the expenses and everything by class, which means by property. So you can break out each property and say this is what it's for. And then if it's paying in working with a corporation, or if it's using a property manager corporation that you also own, you're going to keep a set of books on that. And making sure that those two play well together for your benefit is something that is, if you don't want to learn it, you bring in a guy like Troy and his team, and they handle it. If you like to learn it, then you could absolutely spend the time. It's going to be, how many hours do you think it would take somebody to learn?
Ooh, a lot.
What is a lot? Like 20 hours, 30 hours?
Yeah, probably 20 to 30 hours.
Yeah, I always use the 20-hour to learn a skill number. And now it's just making sure that it's going on the right. Or you just figure out how to keep your general ledger, and then you hand it to a guy like Troy.
Yep.
And my personal view is that most investors' time is better spent doing that. All you have to do is be able to track your transactions. Now, what if somebody's not going to sit there and keep a spreadsheet of their transactions?
Then they can hire someone like me to do it for them.
And what do you guys do? What would you do? You'd go to the bank accounts, credit cards, and everything,
absolutely.
and just grab all the transactions?
Yeah, a lot of times what we like to do is we get what's called administrative access to a bank account or a credit card. That allows us to see the transactions, and that allows us to classify it. Doesn't allow us to move money around or anything like that. So there's no fear about that.
So it doesn't. Now here's a rule of that you should live by. Your bean counter should not be your check writer. And I'm just going to repeat that because this is how 99% of companies get ripped off. Bean counter should not be check writer. So Troy and his team might be able to see transactions, but they can't write checks.
Correct, absolutely.
Nor should you ever have a situation, because all it takes for a bookkeeper, if this hasn't occurred to you yet, they could write a check to a company, they could set up their own company, pay it, and call it an expense. And then your money's disappeared. Or they write it to cash. Or they write it to a company but then cash the check. Yep. In Vegas, the casinos are kind of known for taking checks from just about anywhere. And that's what usually happens. Yep. So I'll just put that as a timeout. All right. So if somebody can keep a general ledger, it may not even be they have to do anything. It may be that you simply give access to somebody to look at your transactions, and then what do? You ask them, what was this for?
Exactly, yeah. If there are transactions we can't figure out what they are, we'll send you what we call our Ask My Accountant list. So it's a list of all the transactions we're not sure on, need some clarification.
Okay, and that's fair.
Yeah.
All right, and now I'm going to tell you guys a quick story, and then I'm going to ask more of the common mistakes.
Okay.
Quick story was we went through a pandemic, And there was these things called PPP loans and economic injury disaster loans or EIDL loans and different types of relief. And the first requirement on almost all of those was your P&L on your balance sheet from the previous year or your tax return, which might have balance sheets on it, right? In either way, you needed to have books to qualify for any of these. And we were sitting there and we were getting books that were on napkins. We were getting books that were scribbled out on a tablet paper where people were just kind of jotting things down. I think these were what my expenses were. That gets rejected. Nobody's going to take that. The way you need to look at your books is, what if the IRS or any third party, a lender, walked in and looked over your shoulder and said, how's your company doing? It's like your vitals. It's no different than taking your pulse, taking your blood pressure and all those things. For a person, maybe doing a blood test, it's just a bunch of numbers. You gotta have good books if you're gonna get loans, if you're gonna get access to incentive. All sorts of different programs are generally conditioned on your ability to provide some sort of good record. If you want solar credits or any of that stuff, you need to have records of those transactions. All right, that said, off my soapbox, what other common mistakes have you seen?
Biggest one, happens all the time. People try to overcomplicate it. It's not rocket science. We as accountants like to say cool phrases and cool words like debits and credits, but it's really not that complex.
Well, sometimes a debit's a credit, and the credit is a debit.
Yeah, well.
And sometimes a credit is a debit, and a debit is a credit. They do goofy things in accounting, like they try to make it as difficult as possible. So depending on where you're at, it might be a credit or it might be a debit. So don't do that, right?
Yep. So the main thing that I would say to keep it simple is your chart of accounts. Keep a simple chart of accounts. Not everything needs its own account. Combine things into one account when possible, like so you don't need a McDonald's expense and a Taco Bell expense. Use meals expense.
Right.
It seems like common sense.
You said chart of accounts.
Yes.
In English, what is a chart of accounts?
It's a listing of all of the accounts that you can classify your transactions to.
So it's here's all my deductions, right? Hey, maybe it's vehicles, maybe it's meals, maybe it's utilities, maybe it's computers or equipment. That's a chart of account. And what's a typical company? How many chart of accounts? Like how many items on a chart of account was
Probably somewhere between 30 and 50.
Perfect. You understand what we're saying? There's literally, here's what it could fall into. There's maybe 30 or 40, 50 categories. If you're at a really complicated company, it's 50. If it's most, I see, are probably in the 20 to 30 range. Yep. You deal with a, much more difficult. But a typical real estate investor, for example, how many items might be on a chart of account?
25.
Yep. So you just have, here's where we could call this. Don't create a new expense item for everything.
Correct, absolutely.
Like you have meals and entertainment, well, no more entertainment, but you have meals, 50%. You have meals, 100%. You might have vehicles. What are there some common areas?
Computers and equipment, small tools and repairs, office supplies, general supplies, repairs and maintenance, property taxes, licenses and fees.
That's a chart of accounts. So whenever you hear an accountant say, oh, this is your chart of accounts, what it is these are the categories things could fall into. Makes it much, much easier.
Absolutely. Yeah, we're not running Fortune 500 companies for the most part, so we don't need 200-page long chart of accounts. I've seen some nasty ones in my day.
I've seen it.
Yeah.
I've seen them, and it's like every item has a different thing, and they want to call each bank, hey, I have 10 bank accounts, and they're all different. Like, you're like, stop that. Like maybe on your balance sheet you could break out your balances. Otherwise, just call it checking.
Yep.
Make it easy. Don't make it hard. All right. So people make it overcomplicated.
Right.
What do you think? Why do you think they do that?
They don't know what to do.
Yeah. So when in doubt, call your accountant.
Yep.
Call your bookkeeper.
And that feeds into my next tip.
All right.
My next tip is don't guess. If you're not sure on how to classify something, use Ask My Accountant as an expense type on your chart of accounts. And that allows us to have a discussion with you to figure out what this should actually go for. Because what's difficult is when people guess and they guess wrong, we have to go through every single line item to make sure that everything's accounted for properly.
And I guess this is going to be one of my pet peeves. I used to have a thing called no journal entries. You'll have people that don't know what something is, and they'll put it as a journal entry, right? They'll just categorize a bunch of stuff that they don't know what it is, and they'll just make a single entry for all those things. Don't do that, right? Your general ledger, put it on there. If you don't know what something is, we say put AMA next to it, right? Ask my accountant, and figure out how to categorize it, where it goes appropriately. Because sometimes there's 2 or 3 places something could go.
Absolutely,
right?
yep.
And we're saying, well, if you put it here, here's the ramification. If you put it here, here's the ramification. Sometimes it doesn't matter, right? Let's just be consistent. This is where if we're going to have this type of expense over and over again, let's just figure out at the outset where we're going to put it. And then consistently put it there so that if you're ever using your books, which eventually you will, as you get bigger, you're going to use your books to make projections and to make financial decisions. You need to know that your expenses are, like, I can grab and say, this is how much I paid for my electric last year, or for my property taxes, or for my insurance last year. I need to be able to properly categorize them. It's almost impossible if you break them out and put them into different categories and constantly change it.
Yep.
And make a big mess of a chart of accounts.
Yeah, be consistent. If you're going to be wrong, be consistently wrong. Don't change it month by month.
Yeah, and by the way, you just said something. If you're going to be wrong, be consistently wrong. Right? That just means that it's easy to track. End of the day, pretend like you get taken off the earth and somebody needs to figure out what you did. You're just leaving a paper trail. It's breadcrumbs. And somebody needs to be able to see what you did. And if you misspelled something throughout a book, they can tell what you were doing, even though you misspelled something or miscategorized something in your books. They could still see what you were doing. What else? What other common areas of mistakes, or what are the big tips?
Yeah, another big one is to make sure that you're submitting for reimbursement for things. Don't just, if you're buying something personally, make sure you are submitting a reimbursement log, so you're able to classify what those reimbursements are for. See that all the time where people just take out a distribution or repay their loans from shareholder, but really they're just paying themselves back for something, so they're not getting the credit that they're due.
Yeah, because if you reimburse for something, let's say I reimburse, for example, for a cell phone, that's an expense to the company,
Correct.
right? Depending on how you're set up. Are people not categorizing that and they're just calling it a distribution?
Correct.
In which case you don't get an expense for it and you're going to pay tax on that.
Right.
And so if you're, without repeating everything you said, make sure that if you are paying yourself for something, the expense that you incurred personally for the business, that business is noting it, taking it as an expense, and that it's a reimbursement to you. It's an expense to the company.
Yep, absolutely.
All right, what else?
Probably the last thing that I'd say that we see a lot of is people wait until the last minute to do their books. They're not consistent with it. They don't do it once a month, once a week, once a quarter even. They wait until it's tax deadline time and try and figure it all out then. But the problem with that is memory fades. I don't remember why I bought something off of Amazon April of last year. But if I had proper bookkeeping, good record keeping, I would be able to tell you that, oh, that was for the supply that I bought.
Yeah, and the IRS, it wants what? Who, what, where, when, and why.
Right.
Regardless, even if you're doing meals and you don't have to keep a receipt, you still have to be able to prove meals under $75, by the way. But if I have an expense, even for something that may not require the receipt, I still have to have who was I with, why did I meet, when did I meet, how much did I pay, and what was the business purpose for that.
Yep, and within bookkeeping, most softwares and in Excel even, you can put a memo of what it was that you purchased, so you're always able to pull back and remember what it was that I bought.
Or use one of these jobbies and take picture, receipt, note, keep it in your calendar. I'm meeting Troy for lunch, and then if you see, there was a credit card statement, and I could see that I paid, $20 for some sandwiches, you'd be able to tie that in and say, I met with Troy. We had a business meeting about bookkeeping, and you'd get a 50% deduction for that, right? Or is it,
depending on the year.
Yeah. It was at 100. Is it still at 100?
Still at 100
yeah.
through the end of the year.
If it's through a restaurant, right? So if you make the sandwich, you get a little no.
Yeah.
But if you go to Subway, There's our free plug for Subway, right?
Send sandwiches, please.
Right, yeah. That's about right. Then you could write off 100%. Even if you order from a restaurant, you could actually write off 100%. But anyway, that's why it's so important. What Troy, you just inadvertently said is we might have two categories, 50% deduction, 100% deduction. In 1 year, the Subway sandwich may go in the 50%, and then the next year it may be 100%. You don't know any better. If you just call it meals, you're going to miss out on a bunch of your deduction.
Yep.
And so that's why you end up working with good bookkeepers, because they're worth their weight in gold, because they're going to make sure things are classified right. You're going to get all the deductions you're entitled to. They're digging around trying to see whether something was a reimbursement where you don't have to pay tax on it, which could be a pretty big amount. Like how big are we talking? Like, do you see people where it's thousands of dollars a year?
Absolutely.
Yeah.
All the time.
Yep, and then just by that itself, like as I say, it's $3,000. It might cost, that may have a net impact on them of over $1,000, which is silly because a bookkeeper is going to cost you a lot less, right? So, anything else? Any last things that you want them to know?
Yeah, like I said, just be consistent. Make sure that you're keeping up to date with your books. Don't wait till the last minute. There's nothing worse than having to do a set of books in 2 weeks and then you're making mistakes, trying to rush to get things done. So be consistent.
And then I'm going to say this before we leave. If you have good books, your tax prep is easy.
Correct.
If you have a good balance sheet, how long does it take to do a corporate return?
Not long.
Not long at all. Like most of the time people are doing return prep, what they're really doing is bookkeeping.
Right. And our tax preparers cost a lot more than our bookkeepers.
Yep. So the best use of your time is to either figure out what information you need to provide to good bookkeepers, or set up a good chart of account for yourself and manage and discipline yourself and learn it so you're able to keep good books, because it's going to save you hundreds of dollars per hour of somebody else trying to interpret it. If you could just hand your accountant a completed balance sheet, and here's my P&L, and even here's my general ledger. Like, you give them those things and it's nice and crisp, they're able to take that information and very easily create a tax return. Whereas if you didn't have that information, they're going to be spending their high dollar amount per hour churning away, trying to figure out what you did during the year and trying to guesstimate and reading tea leaves. And sometimes they just deny your expense outright. They don't even tell you because you don't have backup, and they say, oh, I can't include that, I can't include that. And they don't really even let you know. And they'll just disregard it completely, saying, well, we didn't have very good books. We didn't have a mileage log, so we didn't write off any mileage. You know, all those things really hit you pretty hard, like it costs you a lot of money. Do good books. The number one killer of businesses is running out of cash. The number one reason people run out of cash is because they don't understand the relationship between their income and their expenses and their assets and their liabilities, and they get themselves in a bad spot. If you have good books, you'll be able to see, am I making money? Am I losing money? Is my equity increasing because my assets are growing faster than my liabilities? And you're able to look at things quickly. If you have a general ledger, you can see, hey, are there expenses that normally I pay that I haven't paid yet? Like sometimes this happens. You'll have a surprise, 6 months, somebody hasn't paid a bill, and all of a sudden you have it. That's why you get into a rhythm of seeing certain expenses. A good bookkeeper is going to say, hey, I haven't seen your insurance expense on your properties, or hey, we haven't paid property taxes. Last year it was $6,000. Where is it? Yep.
And on that note, having good books allows for good tax planning as well, because you're able to know where you stand at all times, so you can have a good idea of what you're going to owe tax-wise.
100%. Now, good, better, best. Is it good to do quarterly taxes?
It's good, yes.
Is it better to do monthly?
Absolutely.
And is it best to keep accurate books and records as you go along contemporaneously with all your expenses?
Absolutely. The majority of our clients can get away with monthly. But yeah, if you had an in-house bookkeeper that could give you bookkeeping daily or weekly even, that would be best.
All right, and that's it. If there's anything else,
come to us. We're here for you.
You got it.